stocks locking in another round of fresh all-time highs ahead of Thanksgiving. But beneath the surface of this record run, there is one stock that could be shooting off major warning flares. Deere tumbling today after the tractor maker cut its forecast, citing lingering trade tensions. So is Deere telling the true story of what's going on in the market? Dan?
Listen, we've been watching a lot of these industrials. We know that, as investors have gotten more excited about the potential for a phase one trade deal, there was this rotation into cyclicals, but these stocks had already run into it. So I think it's really important when you think about, what is the sort of forward visibility these companies have, and they don't have much. And I would just tell you that any of these industrial companies who get a lot of their sales overseas, who tell you otherwise, are not being particularly honest about it. I think you have to take this move seriously. That was down 5% today. This is a big industrial stock. It's not a nice move, but I think you want to kind of keep that sort of lack of visibility in your investment framework as you start thinking about how things play out into 2020.
Yeah, I think it's a cautionary tale. There is a lot of optimism built into this market at this point in time. And Deere just shows you what happens when all of a sudden the floor drops out on it, right? So as we go into 2020, you talk about, can we get these tariffs off? Is the trade deal going to come in? Are we going to get some sort of reacceleration in global growth? That's what the market's pricing in today. And hey, listen, it could be right. But if it's not, then you're in for some tough sledding. The one place that I would look into 2020, look at the high yield bond market. That has not confirmed these new highs. That's a concern.
Is there a shot that this was a kitchen sink sort of quarter? I mean, let's throw in trade tensions. Let's throw in weather, all these things.
And the one that's at the target spot is a company that addresses the whole ag end of this, and that's the one that's in flux when you start to talk about the trade, whether it's going to be phase 1, 2, or 3. But it's really hard to sell the market when you know that there's multiple phases that are coming or possibly coming, correct? So.
All right, let's stick with trade here. Let's take a look at how things are stacking up in the trade war. This is all the recent data from both the U.S. and China. You can see the U.S. economy is holding strong, backed by a solid labor market, while China just handed in a weak batch of economic data. Our next guest says trade is one factor that could add fuel to Wall Street's record rally. Let's bring in Wharton finance professor Jeremy Siegel. Professor, great to have you on the show.
Good evening.
I want to start off with your bold prediction of 30,000 on the Dow. We like round numbers. Right. You do too. What kind of time frame are you talking about?
Well, don't forget, 30,000 is only around 6% away. So, right. I mean, that's less than, half of what we had this year. I think it's real. I think, we've been talking about what happened Deere, the uncertainty on trade. Trade is the major issue facing the market. If we get phase one deal, if Trump, normalizes with Europe, if we get signed on the Canada-Mexico agreement, 6% seems to be maybe even modest in that case. But, if we get those, we're not cheap. We all know that. Selling for 19, we go another 6%. That's 20 times earnings. So we would have to see, a good economy next year for us to get much more than that. So I see a pop with a phase one deal, getting to 30K, then it's going to labor a little bit harder after that.
What's a good economy in your view? Is it an economy that's better than what we've seen this year? And I'm just trying to gauge this because, if you are banking on a good economy, do you think that it's the trade deal that will make this economy good?
Yeah, well, don't forget, it's not just our economy, it's also the foreign economies. Europe is beginning to look a little bit better, a turnaround. In the U.S., by the way, I was very comforted by the data we got today on durable goods, particularly jobless claims, which got me a little bit worried last time. We've seen the PMIs turn around. That scare that we had a month or two ago is easing. It's also easing in Europe because of Germany. So people are saying we may have, passed that dip. Doesn't look like a recession. If Europe gets better next year, emerging markets improve next year. With the S&P, 40% plus of their profits come from foreign sales. You just can't look at the U.S. You have to look there. I think that's what the market is actually looking at. Good trends there. A deal on trade with interest, with the 10-year staying at 170. What's there not to like? about equities.
No, that's fair. Professor Siegel, just play devil's advocate. Warren Buffett indicator, the Wilshire 5,000 over GDP, 140-something%, I think. He's got $122 billion of cash sitting around. The S&P 500 to market cap over GDP's roughly 148%, levels that we last saw, 19 or so years ago. Are they concerning at all?
Well, I've always questioned, I love Warren, but I've always questioned that indicator relative to GDP because, as I just mentioned, 40% of the profits are from foreign sales. So 40% of their value is world GDP, not just U.S. GDP. So when you go back in history, back in 1950, 1960, it was 100%, 95%. Today, it's 60%. So my feeling is that is not a good long-term indicator to talk about the valuation of the market.
Professor Siegel, it's Brian Kelly. So I'm curious, is there a period where it's taken too long to get this trade deal done? So let's say we're into Q3 of next year and we're still talking about phase one. When is it too far and when is the damage already done and irreversible?
Well, the first thing, we can't get the 25% tariffs. So, if we move there, it's bad for the market and bad for the economy. No phase one is a kind of a muddle through. In other words, a standstill. And if we don't get it with that standstill, with that threat of an increase later, it's going to be hard, I think, to get much of a pop in the market because, again, we're not selling at a cheap ratio. So, muddle, no agreement. Muddling through at this level, I think progress is going to be really hard from this level.
All right. Professor Siegel, great speaking with you. Have a happy
Thank
Thanksgiving.
you very much.
Professor Jeremy Siegel of the Wharton School. Do we have 6% in us on the Dow Jones Industrial Average if we have phase one?
I think, of course, if you have phase one, because then other phases are more likely to come behind it. So I think we definitely have that. Because everyone said that it was not going to get done. Everyone said that China could wait us out. I think that they have a vested interest in not waiting us out. But it's about perception. We thought there was going to be an earnings recession this time around. So going into the first quarter of 2020, where is the benchmark? Where are estimates? What is the perception? And if we leap over them, we go higher. If we fall short, we're going lower.
I just push back a little bit about the phase one, and then that opens the door for 2 and 3. I think that the Chinese obviously have an incentive right now to negotiate a phase one with as little concession as possible on the bigger issues as it relates to buying soybeans or whatever. And then they
already
actually
started to bend on IP.
But what I'm saying is, but did they, though? I'm just saying, but did they? And my point is that I think you will see a deal in the next few, weeks, months, or something like that for phase one, and then you may not see another deal until after the election. That's only
fine,
point.
But it also keeps the bears sort of in the corner because they could come at any moment because no one thought phase one was coming.
It's only fine, Steve, if they turn back some of the existing tariffs, because some of the existing tariffs have been away.
We're at all-time highs right now. If phase one happens,
everybody is thinking that phase one is going to happen, and that's why we are at record levels.
Yeah.
Well, let's go back a couple of weeks. There's no way you could say that there's no way that anyone was on this desk saying that we thought that phase one was going to get done. That was not a unanimous consensus.
No, hold on. Back then, though, Steve, there was no phases. It was a trade deal. So then they hacked it up.
Okay, so phase one, we changed it to phase one.
Phase one is nothing. Phase one is really just not doing new tariffs. That's all it is. And then buying soybeans.
No. China came out and said that they were more positive moving forward, and they felt that phase one was going to get done, and IP is being discussed. This is not talking about just ag anymore.
Okay, well, let's see if there's IP as a part
Everyone
of phase
said
one.
it wasn't going to get done. Everyone said that phase one wasn't going to get done.
It's still not done.
Okay. And short the market, and we're at all-time highs, and that's exactly what happens.
You guys got split up.
I'm not playing.
No.
Such a dumb
That's
game.
not. It's not.
Hold on. You have different views of this, but do you both agree that there's a melt-up in the market that will continue?
No, I think it's going to be like January of 18 once they finally
You can't short the market, though. You can't short the market with this overhang. If it comes out that China says we are not doing any deal permanently, then it's a short. But until then, you're going to keep on your heels, and the bears are going to get run over.